Most people think paying their house off means they're finally safe. But in today's system, housing has quietly become a backbone for public debt and tax extraction tied to your income, not your mortgage. In this video, you're going to see how property values, municipal bonds, and household paychecks are now fused together, and what that really means for your long-term security. Housing in the United States has always been part shelter, part asset. But over the past few decades, it has become a core funding mechanism for local governments and Wall Street alike. State and local government debt roughly tripled from about $1.2 trillion in 2001 to around $3.1 trillion in 2022, and a large slice of that is serviced by taxes that sit directly on top of real estate. In 2019, K-12 school debt alone was nearly $500 billion, up about 118% since 2002, and a lot of that is backed by property tax revenues. Total U.S. municipal bond debt outstanding, states, cities, school districts, utilities, is now around $4.3 trillion, and that mountain of obligations depends on tax bases rooted in land and buildings, not just income or sales. When you look at your house, you see equity in a roof. When your local finance office looks at it, they see collateral that can support more borrowing and more long-term promises. Property taxes are one of the most powerful revenue tools because they target an asset you cannot easily move or hide, your home. Unlike income taxes, they apply whether or not you had a good year, got a bonus, or even kept the same job. Many homeowners in higher tax states face effective property tax rates in the 1.5% to 3% range on assessed value each year. On a $400,000 assessed home at an effective rate between 2 and 3%, that's roughly $8,000 to $12,000 a year flowing out of the household as a non-negotiable bill. Over 20 years, that single line item adds up to about $160,000 to $240,000 in cumulative payments, without reducing any mortgage principal or increasing your ownership stake. For local governments, that is precisely the point. Property taxes are a durable, predictable cash engine that can be pledged against long-term bonds. If you want to see how tightly housing and debt are connected, look at school district and municipal bond markets. School districts alone carry roughly $450 to $500 billion in direct bond debt, second only to state governments among municipal sectors. Across the entire muni universe, outstanding bonds sit around $4.3 trillion as of mid-2025, and new issuance is on track to exceed $500 billion in 2025 alone. K-12 school issuance remains steady, with hundreds of millions of new school district bonds coming to market in a single week during active periods. Those bonds are not theoretical. Their debt service, interest and principal, has to be paid year in and year out. And the most reliable way to guarantee that cash is to lean on property tax revenues that can be adjusted far more easily than household wages. When a district sells new bonds to renovate schools, build facilities, or refinance old debt, it is effectively promising investors that local homeowners and businesses will shoulder higher millage rates or extended tax timelines if needed. All of this only works as long as households can actually carry the load, which is why the income side of the equation matters so much. U.S. real median household income, adjusted for inflation, sit at about $83,730 in 2024, essentially unchanged from 2019 after you account for price increases. In 2024, the median household brought in about $83,730, roughly flat in real terms compared with the pre-pandemic period. Income gains have been uneven, with higher-earning households seeing bigger jumps than those at the bottom, which tightens budgets for many owners sitting near the median. When incomes stall in real terms, while property-linked obligations keep rising, the margin for error shrinks. Surveys over the last few years have repeatedly shown that a large share of Americans would struggle to cover a surprise bill of a few $100s without borrowing or cutting essentials. That fragility is what turns property taxes, insurance, HOA fees, and debt service from routine line items into potential trigger points for delinquency or forced sales.
One of the least understood features of the municipal market is how rarely large debts are completely paid off and retired in the way a family tries to eliminate a mortgage. Cities, counties, and school districts habitually refinance, issuing new bonds as old ones mature, often extending maturities further into the future. Annual municipal issuance is projected above $500 billion in 2025, with refundings and refinancings making up a significant slice of that total. As of the second quarter of 2025, outstanding muni debt has grown to about $4.3 trillion, up nearly 4% year over year, indicating that the overall stock of obligations is still expanding. For investors, this is standard fixed income plumbing. For households, it means that every new wave of bonds adds to a long-term stack whose servicing ultimately traces back to tax bases and fee structures tied to property. The political path of least resistance is often to stretch maturities, refinance at prevalent rates, and rely on rising assessed values to support larger nominal debt loads without admitting a hard default. The era of near-zero rates made that rollover strategy look painless, but the environment in the mid-2020s is very different. As interest costs rise, every refinance becomes more expensive to service, which puts direct pressure on budgets and, by extension, taxpayers. Municipal bond issuance has remained robust, but managers point out that higher coupons and a softer supply-demand balance have pushed borrowing costs up relative to the ultra-low rate years. As older, low-coupon bonds mature or reset, some issuers now face the choice of cutting services, raising taxes, or accepting higher debt service burdens that crowd out other spending. This is where the link back to housing tightens. If a district or city refinances at higher rates but still wants to preserve services, the easiest lever is frequently the tax rate or assessment base on local property. For the homeowner, that shows up as upward pressure on that yearly bill, even if their income hasn't meaningfully increased in real terms. When you track the cash, you start to see how much of the system's design prioritizes investor certainty and financial sector stability over household flexibility. On every bond sale, underwriters, advisors, and law firms are paid upfront fees, while investors receive interest payments long before principal is fully repaid. In 2021, for example, Philadelphia's school district spent about $311 million servicing its debt, with over half, roughly $162 million, going to creditors as interest rather than paying down principal. Across the national muni market, trading volumes and issuance remain high, and fee-generating deal flow continues even as some local tax bases wrestle with stagnant incomes and rising costs. From a household's perspective, that means a growing share of local dollars is effectively pre-committed before school programs, road repairs, or new services are even debated. The system is designed so that bondholders sit at the front of the line, and property-linked revenue keeps them whole as long as possible.
Zoom out from local balance sheets, and you see a related pattern in how global institutions are positioning themselves. Over the last several years, central banks worldwide have been net buyers of gold at a pace not seen in decades, accumulating more than 1,000 metric tons annually in some recent years. The World Gold Council's 2025 survey notes that central banks continue to diversify reserves away from a narrow concentration in a few major currencies, citing concerns about long-term financial stability and geopolitical risk. Analysts highlight that this level of official sector gold demand historically coincides with periods of elevated anxiety about debt sustainability, currency credibility, or both. At the same time, investors are questioning the safety of long-duration government paper relative to hard assets and shorter-term instruments. That doesn't mean an immediate collapse, but it does signal that large players are hedging against scenarios where debt keeps growing faster than the income and productivity that ultimately must support it. From the vantage point of a homeowner or real estate investor, the takeaway is not that the system stops tomorrow, but that the risk profile of paid-off housing has changed. Even with no mortgage, you sit on top of a stack of obligations that can still rise: property taxes, local assessments, insurance costs, and the indirect impact of higher public debt service on services and fees. Real median household income has been roughly flat in inflation-adjusted terms since before the pandemic, while many core housing-related costs and tax burdens have drifted higher. Municipal and school districts continue to issue and roll debt, often assuming that the tax base and property values will remain strong enough to shoulder the burden. For an owner, that reality demands a more analytical approach to affordability than just principal and interest. The true carrying cost of a property now includes a growing public finance overlay that is largely outside of your direct control, but directly linked to the stability of your household income. Most people still evaluate housing as if the story ends when the mortgage is gone, but in a world of flat real incomes, rising property-linked obligations, and trillions in municipal debt, ownership is really about managing the cash flow pressure that never fully disappears. If you want more deep dives like this on how housing, debt, and policy actually intersect, make sure you subscribe to Housing IQ and stay ahead of the changes shaping your financial future.